Nokia stock closed its most recent trading session on Friday, May 1, 2026, at a price of $13.30 per share on the New York Stock Exchange. This represented a solid gain of over 3% during that session, pushing the company toward a valuation level that many market observers thought was years away. While most retail investors still associate this name with the colorful plastic phones of the early 2000s, the current reality in the market is that this is no longer a consumer hardware story. If you are looking at the ticker through the lens of a mobile phone company, you are missing the massive structural shift that just sent the stock surging toward a 16-year high. The gap between what the public expects from this company and what the institutional data is actually showing has rarely been wider. Most people expect a slow, cyclical recovery in telecom equipment, but the reality is that the demand for high-capacity optical networking and AI-ready data center connectivity is moving at a pace that is completely decoupling from the traditional cellular tower business. This is where the tension lies for anyone using a Fidelity mobile app or checking their Robinhood investments today. You see a name that feels like a legacy brand, but the underlying numbers are starting to look like a high-growth infrastructure play. The recent movement we saw on May 1st was not an isolated event. It followed a quarterly report that effectively shattered the narrative that the telecom sector was dead in the water. While companies like Ericsson has struggled with a cooling 5G infrastructure market, the latest figures show that Nokia managed to beat earnings expectations by over 30% while significantly expanding its gross margins. When you look at the intraday swings we have been seeing lately, it is clear that institutional activity is picking up. We are seeing heavy volume on the buy side every time the price dips toward its previous resistance levels. Large funds are likely rotating into this space because the valuation, even after this recent rally, remains relatively grounded compared to the astronomical multiples we see in the pure-play AI chip sector. If you are managing your own portfolio through interactive brokers or using SoFi Active Investing, you have likely noticed that infrastructure is becoming the new defensive play with an aggressive upside. The market expects a quiet summer, but the reality is that the backlog for optical networking equipment is hitting record levels, and that is a story the broader media has not fully caught on to yet. One of the most striking insights from the recent trading activity is the surge in the network infrastructure segment. While mobile radio networks, the stuff that goes on cell towers, actually saw a slight decline in reported revenue, the optical and IP networking divisions are growing at a double-digit clip. This is the curiosity loop that smart investors are paying attention to right now. Why is a networking company growing while the mobile carriers are spending less? The answer lies in the massive build-out of data centers. Every new AI facility being constructed requires miles of fiber and incredibly sophisticated switching and routing equipment to manage the sheer volume of data being moved between server racks. This is where the company has positioned itself as an essential provider. The market narrative says that until people start buying 6G phones, these stocks stay flat. The reality is that the plumbing of the internet is being replaced right now to handle the workloads of the next decade. If you are looking for investment help or researching the best investing sites, you will find that the smart money is looking past the 5G fatigue and focusing on this back-end infrastructure. The trading volumes we have seen over the past week suggest that there is a high level of conviction among those who understand the synergy of the recent Infura acquisition. By bringing that technology under their roof, they have effectively consolidated their position in the American market, which is where the highest growth in cloud demand is currently located. Institutional investors often use tools like Schwab Intelligent Portfolios to balance their tech exposure, and we are starting to see this name appear more frequently in those algorithmic baskets. It is a sign that the company is moving from a speculative turnaround play to a core holding for diversified portfolios. The intraday volatility has actually been decreasing, which is usually a sign of institutional accumulation. When a stock climbs steadily on rising volume with fewer wild swings, it means the weak hands are being replaced by long-term holders who are willing to wait for the full realization of the current guidance. Comment below how many shares of Nokia stock you currently hold, or if you are waiting for a dip below the $12 mark to enter a position. Looking deeper into the business model, the company operates across 4 main pillars, but the one driving the most excitement is the technology licensing arm. This is essentially a high-margin, pure profit engine. They own a massive portfolio of patents related to connectivity that almost every smartphone maker and automotive manufacturer in the world has to pay for. In the most recent quarter, this segment saw double-digit growth as new licensing deals were signed in the consumer electronics and multimedia space. This provides a massive cushion for the company's cash flow. When you are self-investing or using a Fidelity trading platform, you want to see a company that has sticky revenue that doesn't depend on selling a new product every single day. This patent library is exactly that. It is a recurring revenue stream that supports their research and development into next-generation connectivity without forcing them to take on massive amounts of debt. As of the end of the first quarter, they were sitting on nearly $5 billion in cash and equivalents, which is a staggering amount for a company that was considered a laggard just a few years ago. The contrast between the expectation of a phone company and the reality of a connectivity powerhouse is best seen in their private wireless network business. This is a sector that barely existed 5 years ago, but is now serving over 850 enterprise customers globally. We are talking about private 5G networks for automated warehouses, nuclear power plants, and massive shipping ports. These are environments where standard Wi-Fi simply isn't reliable enough. By providing dedicated, secure, high-speed networks to these industrial giants, they are creating a deep moat for themselves. It's much harder for a company like Amazon or a major logistics firm to rip out a private 5G network once it's integrated into their automation systems than it is for a consumer to switch cell phone brands. This shift toward industrial digitalization is a multi-year trend that's providing a very stable floor for the stock price. If you are looking at online investing through Robinhood or SoFi, these are the kinds of fundamental shifts that create long-term value. While the mobile infrastructure part of the business has been stable but unexciting, the management has been very clear about their expectation for a recovery in the second half of 2026. They are projecting that as interest rates stabilize and carriers finish their initial 5G rollouts, there will be a new wave of spending focused on network capacity and standalone 5G cores. This is the reality that many bears are ignoring. They see the current flat growth in tower equipment and assume it stays that way forever. But the reality of network traffic is that it only goes one way, and that is up. As AI agents and high-resolution video become even more integrated into our daily lives, the existing 4G and early 5G networks will hit their limits. This creates a mandatory upgrade cycle that the company is perfectly positioned to capture. They have already raised their growth guidance for the network infrastructure segment, signaling that they see this demand coming sooner rather than later. From a macroeconomic perspective, the company is also benefiting from the rip and replace initiatives in various Western markets, where government regulations are forcing carriers to remove equipment from certain high-risk vendors. This creates a massive opportunity for a trusted European-based provider to gain market share in regions like North America and the EMEA. The Americas region already showed growth in the most recent quarter, driven specifically by this demand for secure, high-performance networking. For those using Fidelity IRAs or managing long-term wealth, this geopolitical tailwind provides a level of security that many other tech firms don't have. They aren't just selling a product, they are selling national security and reliable infrastructure. This is why you see the stock holding its gains even when the broader tech sector faces a bit of a sell-off. As we look toward the future, the scenarios for this stock are becoming increasingly focused on the intersection of AI and connectivity. The expectation is that AI is just something that happens on a chip, but the reality is that AI is a networking challenge. Moving the massive data sets required for large language models requires a level of optical density that very few companies can provide. The management recently introduced a next-generation amplifier that scales fiber capacity 8 times over existing products while being more energy efficient. This is the kind of technical leadership that keeps a company relevant. If they can continue to lead in the optical and IP space, the stock has a clear path toward testing its old highs. The risk, of course, is that the global economy slows enough to delay these massive infrastructure projects, but given the competitive necessity of AI for most large corporations, that seems less likely than a continued aggressive build-out. The authority this company is building in the private wireless and industrial space cannot be overstated. By focusing on mission-critical environments, they are building a business that is far less sensitive to consumer spending habits. This is a key distinction for anyone doing individual brokerage or using a SoFi trading platform. You are not betting on whether people want to buy a new gadget this Christmas. You are betting on whether the world needs more data, faster speeds, and more secure connections. The answer to that is almost certainly yes. The recent dividend payment and the ongoing share buyback program also show that the board of directors is confident in the long-term cash generation of the business. They aren't just hoarding cash, they are returning it to shareholders while still investing heavily in the future of the network. To wrap this up, the story of this ticker is one of a profound transformation that is only now starting to be reflected in the stock price. The expectation that this is a slow-moving legacy player is being systematically dismantled by a reality of high-growth optical networking, a robust patent portfolio, and a dominant position in the emerging private 5G market. We saw the stock touch a 16-year high on the back of a strong earnings beat, and the underlying institutional accumulation suggests that this is the beginning of a larger move rather than a blow-off top. Whether you are using Robinhood for fractional shares or a Fidelity Wealth Management account for a larger position, the key is to look past the brand's history and focus on its current role as the essential plumber of the AI and data center world. The contrast between the public narrative and the financial reality has created an opportunity for those who are paying attention to the details of the networking infrastructure. Keep a close eye on the volume levels at the $13 support mark, as that will likely be the launchpad for the next leg higher as we move into the second half of the year. The depth of their technological moat and the massive amount of cash on their balance sheet make this a unique play in a market that is often dominated by overvalued hype.
This is a story of substance meeting a structural shift in how the world connects, and the market is finally starting to give it the credit it deserves.